focused on helping companies with passionate, loyal communities and customers around their business, being able to leverage those communities by raising equity from them. So excited to be here today. Thanks for having me.
Sure. Thanks for joining us. Kinsey is the Business Development Director for Start Engine, which is another platform in this space that's been around from the early days. It was the first one I was aware of. And you can tell us a little bit more about what you guys are doing.
Yeah, sure. Start Engine was actually we launched the first Reg A Plus raise to close in January. Elio Motors, they raised $16.92 million from almost 7,000 non-accredited investors, which is pretty incredible because a lot of people didn't think that it was possible. So we're really excited about the future of this regulation and other new equity crowdfunding possibilities.
And Jillian is an attorney who's been doing crowdfunding raises for quite some time.
Yes, hi, my name is Jillian Sidoti. I'm with crowdfundinglawyers.net, and I wrote a book on crowdfunding called The Crowdfunding Myth. Basically, I've been working with syndicating films since about 2008, and I also brought one film company public. And I love Reg A Plus because it really gives an opportunity to smaller businesses to reach a vast marketplace of investors. So I'm really excited to see what happens in the space.
And then Melinda Moore, who I've known for many years, is probably one of the top marketers in this field, and she's just written a book too.
Yes, my name's Melinda Moore. Happy Friday, everybody. Thanks for being here. So I'm the CEO of More Media Ventures, which is an agency that helps issuers and entrepreneurs raise significant amount of funds through crowdfunding. I've run well over 100 crowdfunding campaigns with some pretty big people as the CMO of Crowdfunder, as well as on my own. So I've worked with Yao Ming, I've worked with Neil Young, I've worked with Laird Hamilton, and then I've worked with a bunch of people that are not famous, helping them raise money. And I recently just wrote the book, How to Raise Money, The Ultimate Guide to Crowdfunding, which is, I'm gonna plug it, available on Amazon right now. I highly recommend that you get that book. It really just sort of outlines, what you need to do to run a successful campaign and how to choose the right platform. So that's, and the reason why I'm doing this actually is I've been an entrepreneur, so I've had 2 exits, so I know what it's like to raise money, and I feel like there's never been a better time to utilize crowdfunding in order to raise money and bring your company to life.
By the show of hands, how many people in the audience have content projects that they're looking to crowdfund? And how many of them have digital media projects? They're companies that they're looking to crowdfund. Okay, so that kind of gives you the composition of the audience. So I'm going to start with Vincent. Tell us a little bit, why did you start this platform, and what are you seeing as the opportunity for crowdfunding?
Yeah, so we started Flash Funders a little over 3 years ago, and I started it with a very successful serial entrepreneur, billionaire tech investor, and he was able to bring a lot of resources from a broker-dealer license to a securities law firm to the table, which is really important for navigating this space. I had personally just come off a startup where we needed to raise capital and we weren't able to raise capital, and I had to wind the business down, and had a little bit of traction but not enough, and it was a very difficult time to raise capital, 2008, 2010. And I had done a startup before that when I was at college in Michigan, and it struck me how inefficient the capital raising process was just through the traditional routes. And when I talk about efficiency, I mean just emailing and spreadsheets and dealing with lawyers and banks, and it's an awful experience. So that was one piece. We could use technology to do this thing more efficiently. But also, I had passionate people around my business. I had a mobile gaming sports virtual currency app, and I had a bunch of loyal customers who were excited and really disappointed when we wound the business down. And I wasn't able to fully leverage that community. And so with Flash Funders, that's initially where I got really excited. I started researching and looking at how can I take advantage of these people, my customers, more effectively. And the stars aligned when I was able to meet my co-founder, this serial entrepreneur, and he had a little bit different vision. When we talk about where this industry is going, I probably thought 3 or 4 years ago that it was going to be one or two really big marketplaces, similar to Kickstarter or Indiegogo, where companies come on and it's very self-service and you can raise capital pretty efficiently. And I think what I'm seeing now, or at least from my perspective, is it's still pretty difficult. The regulatory climate, the rules that they've instilled are not that simple to launch a round. So you know, when we talk about Reg A plus, we're talking about over 200 grand in filing fees and financial audits. When you talk about Reg CF, which launches next week, you're still talking about in the tens of thousands of dollars to get through a Reg CF offering. And you have to file a Form C, which can be well over 100 hours of work. So it's for quality companies that want to leverage their communities but have the resources to do so, which is a little unfortunate. But the other thing I'll say is just to round up my thought is, I think we're going to see a bunch of platforms that are more investment bank type, where they really cater towards a specific customer, and they really hold the hand of the entrepreneur and do a lot of that work for them. And so I don't think we're going to have one or two marketplaces where you have thousands of companies raising capital. I think you're going to have a bunch of boutiques that do one thing really, really well.
Interesting. And Jillian, is that what you're seeing? Because you've been in the market for longer probably than anyone here.
I think, I deal with a lot of real estate companies, and so a lot of the crowdfunding platforms right now cater towards real estate. But what I've been getting a lot of calls for is, very much, yes, specialized type crowdfunding platforms. I had one a couple weeks ago call me about, for example, the film industry, and one, I don't want to say similar to Flash Funders, but a community-based type investing. So they all cater to something unique and special, and I think you're going to see some that cater to music or cater to some other specialized marketplace, so that the investor can go and know exactly what they're going to get on the platform when they get there.
But I'm trying to understand, why would a platform need to cater to a specific section of entertainment business, for example? What are some of the upsides from that?
Well, I think a lot of it has to do with people invest in what they know. I mean, if you just look at like the most famous investor of all time, Warren Buffett, he would never invest in tech stocks because he doesn't know tech stocks. So I think it goes along the same lines. I've had phone calls about medical devices or biotech type platforms. People are going to gravitate towards what they know, and the platforms themselves have to have a team together to be able to evaluate the deals before they put them on the platform. Because if the platform doesn't evaluate the deals, it's only going to take one deal to fail to drag that entire platform down.
And that's a really important point, because I've invested most of my career in different companies, and a friend of mine called me that I've known for over 20 years, and he was helping me raise money for one of my first incubators, and he started a financial tech company that allows you to aggregate all of your, financial resources in one place, etc. And first thing I said to him, like, I wouldn't know how to start due diligence on this company. It's not what I know how to do, and someone's got to do it for me. And so for me just to write a check doesn't really make sense. So what you're saying, it's not as much about, okay, these people are passionate about your product necessarily, which is the community-based stuff, but these people actually understand what you're doing, and they're putting money where they believe they can actually add value. So that's very new.
Right.
Because in the past, it was like whoever's accredited and can write a check is in your angel round, right?
Right. Oh, absolutely. No, and still under Reg A, it even says, you have to understand what you're getting into here. Not only do you have to understand what you're getting into, but you can't invest more than 10% of your net worth or your net income if you're an unaccredited investor. And I think that's smart, because we don't want to see unaccredited investors lose. We don't want to see anybody lose money. Right. And the minute things start going to a place where there isn't enough due diligence done, we're going to have some serious problems. So let's not have problems.
So for the Start Engine, Kinsey, you have a plethora of different areas of business. You've gone in the other direction. Why have you done that?
We expected to stick with tech when it started. It was sort of we had the same expectation of, we know tech, we'll fund tech companies, that's how we'll do it. And we found ourselves being approached by a lot of different CEOs with really interesting different types of companies. And what we found was that the key factor was really what kind of a community they had. So they could be, communities form around all kinds of things. And so that's what we've seen so far. We were surprised to find ourselves with an airplane company and a car company and also an app for dogs to connect to other dogs because they need that, I guess.
Right.
And medical marijuana, pesticides, and really just kind of covering a lot of bases. And it's honestly, I hope it stays that way because it makes my job a lot more fun. But we really don't know how that climate will continue. I hope it stays varied because I think that's cool.
Crowdfunding is not the place you go, especially with equity, when you have an idea and no customers around your business.
Oh, that's so true.
It's the place to go where you can leverage your community. So if you just have an idea and you have no customers, you probably want to consider an Indiegogo or Kickstarter rewards base where you can build that community and that customer base through pre-sales, and then you can roll that into an equity round. But until you have passionate followers of your business, trying to build those on the fly while you're also raising capital is going to be very difficult.
So, Jeff, you've done that. You've done it the challenging way. You built it to 60 million reach. How did you do that?
Yeah, so the company, Newsbeat Social's been around for 3 years already. So the company's already had $7 million in cash put into it and $10 million in services. So for us, it was about deciding where we were going to get our next round of growth capital, because sort of we had done with our angel network. And the company has the profile to go get a VC round done. The question was whether or not we wanted to do that when we could access our crowd. And so as a media business, in December last year, we reached 60 million people. Millions of people watch our news every day. That's a pretty passionate fan base to go raise capital from. So we took a leap to go non-venture, and it's a leap because venture can bring a lot to the table for a company at our stage. It validates the business model, you get some smart money around the table. It makes conversations with institutional investors a lot easier when you have some real stamps of approval behind what you're doing. But that comes with some costs around control. VCs are typically going to want to take control and take some preferences on what you're doing. And we have a pretty independent streak in terms of our culture. So added to the fact that we thought that being a news company, we wanted transparency for our audience about how we made money. We thought there were some reasons from our branding perspective that made sense. And our company burns very little capital. So if you needed to go get $250 million into a startup before you're going to turn the corner, Reg A Plus may not be the right place for you to go. We can raise up to $50 million per year in that kind of offering. But we only burn $200,000 a month in our business. So for our growth plan at this stage, we really need about $25 or $30 million to turn a corner. So all of those things sort of fit together for us to take the Reg A Plus plunge, because we had an audience, because we had low burn, and because we wanted transparency on what we were doing. That hasn't meant that we're just going to our crowd. We have an underwriter, W.R. Hambrecht. We are doing a full roadshow with banks and institutions and broker-dealers, as well as our crowd at the same time. So it's almost like we doubled up on the process. But for us, it was really important to get the valuation right. And the crowd, in our perspective, won't understand the valuation. So for us to bring in our best customers, get them to invest alongside us in our business, to go list the company on NASDAQ and have the stock crater 50% in the first year because we haven't done the valuation right, would be a huge problem for us as a company because our community exists on social. So we've taken an approach where we're trying to go both ways. And even if we don't, to date, we've had some institutional interest, but they're all confused about Reg A. And so a huge amount of what we're doing is marketplace education. For me, that's not a waste of time. If banks aren't going to invest today, they may invest tomorrow. And you can get a lot smarter about your business if you plan on taking your company public, which is what we're doing. That'll help you kind of manage things as you go through the process. So it's a little more complicated. It made a lot of sense for us. I'm not sure it makes sense for all sorts of businesses all the time. But it's so far been very good for us.
Well, the point you just made, Jeff, where you're doing a Reg A Plus, then you plan on going public afterwards, I think is very important for everyone to understand that Reg A Plus is for a company. It's called the mini IPO for a reason. It's really for a company or an entrepreneur that intends to IPO this company in maybe 12 to 18 months in the future. It gets them 50 to 75% of the way there, and then they can skip the last 25%. And I think it's the future. I think it's more efficient, lower cost, and it allows you to to reward your passionate customers by getting them into the company pre-IPO. I mean, I love it.
Yeah.
That's the 60 million uniques a month and $200,000 burn. Like, I'm coming after that when that's
You do
listed.
that every time
Well, I
if
mean,
you
that is-
could,
that
right?
is-
Yeah.
that is a
Why not? I mean, it's great.
That is a big part of it too, which is that, at least in our business, those customers deliver business outcomes for us. So they become the buyers of our apps, the sharers of our news, our most passionate
Lifelong
2%.
lifelong
Exactly.
evangelists.
So they can sort of ride our growth with us, and that fits well for what we're doing.
I mean, I agree with what you guys are doing, but at the same time, I don't want to limit the fact that you have to go public. I mean, it is a mini IPO. You are exposed publicly if you do a Reg A plus, but I don't think for every single company the path has to be to listing and being a company that. I don't want it to be limited in that way as a tool. I think it can be used for a company who says, look, we have this one project we want to fund. You know, we're at a film event right now. So if you have one film you want to fund, syndicate that one deal, and you can syndicate that one film or a real estate project or whatever it might be, syndicate that one deal, and then close it down when it's done, distribute all the income and profits and what have you to the investors and call it a day. Or go public. I don't think, though, it has to be limited to the fact that, hand-wringing, I've got to go public and be listed on NASDAQ in 3 years.
I agree with most of that, but if from an investor's perspective, if I'm investing into a company like his, I want them to go public because I'm going to have liquidity then once they go public, and I don't have liquidity when they're private. So I agree if it's like a film or even a real estate deal where they're going to distribute. But if it's a growth company, this is just for you guys. If there's any investors out there, that I would want the company to list soon after because it gives me more variability.
I agree with that. I definitely
Yeah.
agree
You
with
can
that
sell
for sure.
your shares. It's
Yeah,
liquid right
exactly.
away, which is-
As much as NASDAQ and some people want to have a private capital markets exchange, we're nowhere near that happening.
Right, but we can, and a lot of the companies that W.R. Cambert's working with are, Jeff's going to NASDAQ, but they're OTC at least,
Yeah.
so you can at least take your shares that you purchased in this company and
Yeah.
hope that you can actually sell them very quickly.
Yeah, I think Elio Motors OTC'd right after, right?
Yeah.
They did. So, and I think everybody's made really great points. But one thing I'd like to point out is that we did see Elio go live on the OTC just a few weeks after closing, which was great. But we don't hope that happens every time. To Jillian's point, and to bring up a new point is that for many entrepreneurs, this route is one of the major benefits is avoiding taking on venture capital, and in doing so, maintaining control of their company. So if that's what you're trying to do, if that's one of the reasons you're doing this raise, for example, I talk to a lot of founders who are mostly self-funded because they've done exits before and they haven't been happy with the results of having taken on that venture capital, and they want to do it on their own, and they want to be involving their fans and their community instead of wealthy venture capitalists. So in those cases, we're really hoping that we'll see people maintain control of their companies and keep their job as CEO and be successful and share that in line with the vision that they started with, and not have to do any pivoting according to what one big investor wants them to do.
Mm-hmm.
So Melinda, when you were a crowdfunder as the CMO, you had deals that were basically syndicated to a bunch of accredited investors simultaneously. So you had, angel type investors. That was one of your lists that I remember, and then there was one that was all VCs and later stage investors. And so the crowdfunder really took this idea of sort of squeezing the private equity markets to a flatter perspective. That was like the first step they done. How is that going to change now with some of your Reg A plus, deals?
Well, so I'd say a couple things. One is on the crowdfunder front, they have moved over to a model that's more VC outsourced. So in order to be on the platform, you have to have a notable investor or VC that's already done the due diligence, and then essentially the crowd is then investing on top.
So they're leading still, the VCs, which is the opposite.
Yeah. So with crowdfunders specifically today,
Yeah.
that's just
Yeah.
their position in the marketplace. Really, AngelList is the largest platform that raised like $180 million last year and got an infusion of $400 million from the Chinese. So in terms of the platform that has like the largest investor base, which I think is important for entrepreneurs to understand, is really AngelList. But what I'll say is, I think there's going to be heavy consolidation across the platforms, and primarily that's because when I did my book, I interviewed many of the CEOs of the platforms, including Indiegogo and Kickstarter and many of the equity platforms. And the fundamental universal theme is that most people by nature are trend followers, not trendsetters, which means as the entrepreneur, it really is your obligation to bring investors and passionate people into your deal and not expect the platforms to fill it up. I do think what we saw sort of in the dating universe, where it started with the Match.coms and then it started to get into Christian Mingle and the other like small niche verticals, you're gonna see, because investors invest in when they want in verticals, you're gonna see niche plays across the platforms so that it's more like the Match.com. So in order for the industry to be healthy across, it doesn't matter if it's Title II, Title III, or Title IV, you have to have the right entrepreneurs matched with the right investors. And so right now we're just in a position where that doesn't quite exist yet. And there's just hundreds of platforms out there. So I think it's gonna consolidate and go more niche.
And how does this space interact with the whole, Kickstarter, Indiegogo arena of basically investing in passion and helping projects come along? How do you see these two work? You want to say that?
Yeah, I mean, I think that Kickstarter and Indiegogo are great farm systems for equity crowdfunding. We've had at Flash Funders, we've had pretty in-depth conversations with both of them, and I think that you'll see partnerships between equity crowdfunding platforms and Kickstarter and Indiegogo in the near future. And I think that, so my biggest thing, and where I personally think this industry is going, is Flash Funders and Seed Invest and Circle Up and other broker-dealers in this space and Start Engine. I look at these as the future of boutique investment banking. And I say that because technology isn't going to allow this industry to be as scalable as we would like, because every deal has its own problems and lots of hair. And to make the capital frictionless, which it needs to be, companies are always going to go the pathway of least friction, least resistance. So to reduce the friction, the platform has to get more involved in the offering and more hands-on with onboarding and more hands-on with the company. And that's going to be restrictive in just with scale. And so I think you're going to see platforms that are very involved in the capital raises and providing concierge services to these entrepreneurs. And Kickstarter and Indiegogo will help be great feeders. So if you raise $1 million in Indiegogo or Kickstarter, the chances of being successful in an equity round are going to go up exponentially, because you're going to have built that customer base. And I definitely look at it as like the AAA farm system, if we were using the MLB analogy.
So now to explain some of the reasoning behind that, maybe Jillian, you can talk about Tier 1, Tier 2, the new reg that's coming down. So how does that support what Vincent just said?
Well, so just real quick, so under Reg A, there's 2 tiers you can file under. Tier 1, which allows you to raise up to $20 million and have unaudited financial statements and no ongoing reporting requirements. But for every state that you go into to get investors, you have to get permission from that state. Under Tier 2, you can raise up to $50 million. You need audited financial statements, and you don't have to, and you do have ongoing reporting requirements, and you do not need to get permission from every state. And with that being said, I want to make this message very clear. Do not do a Tier 1. You're wasting your time and your money. And then if a lawyer says, sure, I'll happily do your Tier 1, run, because that lawyer doesn't know what they're doing. Because going to the states is an absolute nightmare, and it's super expensive, and it will hold up your project. You will spend more on filing fees with the states than you will on that audit. So just do the audit. Seriously, just do the audit.
We don't know anyone who's actually done Tier 1. We tried.
Yeah.
One of my companies, GoChip, tried doing Tier 1 and got stuck on like state. and
I agree. I think
Yeah.
it's an absolute nightmare.
Yeah.
I've seen some companies do tier 1 and take it to the offering, and it has ultimately not been successful so far. I think, there are a few occasions though. For example, if you're funding for something that is very, very local and you're in a really big state like New York or California, and you know that all of your investors are going to come from that state, in that case, it might make sense to
Maybe
do
like
a tier
a
1.
microbrewery.
But
or
if,
something.
Yeah.
but if it's a really local thing in California, I wouldn't even bother with Reg A. You just go get a registration by permit in the state of California, which takes even less time. I mean, I've literally gotten a permit in the state of California in less than 2 weeks. So in California, why even bother? And the state of New York, I mean, I'm picking on New York, but
New York's the worst state.
I would never go to New York
Yeah.
for anything. So
I've been in a law when I was 24. I had my second company. I was raising capital, sitting with my lawyer, and I'm paying these people. The paralegal comes in and says, "Just don't raise capital from New York because I'll quit my job if you do." Because the blue skies, the filings in New York are terrible.
It's the worst.
Yeah,
Yeah, but I have seen people do that.
yeah,
No.
it's terrible.
Yeah.
I have seen people get through it though. So
I was
as much
paying-
as
I was
if you're
paying these
dedicated
people.
to it, if you are dedicated to
No,
it, I wouldn't say it's
I agree.
totally you can't do it.
I've gotten pre-Jobs
research.
Act. I got through Illinois and Indiana and a couple of other different states, and I do have one tier 1 right now. But the only reason is I had to have, and forgive the term, I had a come to Jesus moment with the client, and I said, look. You better not. I am only registering this in 2 states, and that's it. Which states are they? And they named it was Colorado and Minnesota, and I said, okay, I'll do that. But if he came to me and said Texas, Pennsylvania, Arkansas, any number of states, Vermont, or New Hampshire, I would have said absolutely not. Massachusetts didn't approve the Apple offering back in the day because it was too risky for Massachusetts residents.
So it's just a really tough way to raise money
Yeah.
through Start Engine or through flash funders if you can only raise it in 2 states. If you don't have approval by all 50 states, it's just a challenge in general. So tier 2 is about 50 million per year, and you can go back to same and other investors. There are no restrictions per se. What are some restrictions, if any?
Investors can invest up to 10% of their net worth or 10% of their income, whichever is less, and they really need to know, they have to understand what they're getting into. So here's my recommendation to you. When you're taking in an investor and you're a smaller company that's just starting out, you are going into a partnership with these investors. So your investors are vetting you. Choose wisely when choosing your investors and allowing them to have the privilege of investing in what you worked so hard for. And that's not in the rules. That's just good common sense.
So now I'm coming from kind of understanding what the filings are. And then the new one is about $1 million raise. It's going to be approved shortly.
Right, Reg CF. And, I think Reg CF is, that's going to be approved on May 16th. And, I mean, it will be interesting. I think that will be good for littler, smaller fundraisers. But as a terms of an overall growth strategy for your business, Reg CF is not the way to go. I don't think. The investors can only invest $2,000 or 5% of their net worth, whichever is greater. You're taking only up to $1 million and a ton of little investors, and that seems like a lot of hard work.
This is more for prototype,
Yeah.
pre-launch type things.
Absolutely.
But it's a way to fund your ideas, which really never existed before. So
That's very true.
That's another way of looking at it. So from the marketing perspective, Melinda and then Jeff, how is this now? How is this going to change the consumer marketing? Because on the same webpage, you can offer your shares and you can offer your product to the consumers, basically.
Right. Yeah, I'm just about to launch a multi-million-dollar campaign where we've actually decided to do because it's a consumer-based company, we've decided to do a direct raise. So we're using Fund America, and we're just taking basically their API and putting the Invest Now
And
button.
they're the underwriter with some of the engines, right? Fundamental.
Yeah, I mean, I mean, there's a couple people in this room that are obviously into like content or something. So I think we have to realize is that as it relates to doing deals, it's really about distribution. So I agree with what Vincent is saying in terms of how important the broker dealers are. But what's interesting is that I'll say two things. One, by doing a direct raise, since it's a consumer, I mean, I'm essentially running a campaign to drive membership and drive investment dollars at the same time. But I'm definitely going out to the broker-dealer networks to get that distribution. Because the distribution, I mean, it's the same thing. It's like if you've created a show, but it's not on Hulu or Netflix or CBS, nobody's going to see it. So I think as issuers, you have to understand how important distribution is, and you also have to understand how important marketing is, and having a very powerful story. We're now in the age of excellence with video, business traction points, a good management team, all of these things, because you are now essentially selling to, over 300 million people that are in the United States, but they have to believe in your value proposition and that you're truly solving something, solving a problem in the marketplace, and that they want to get in. And I do think the advantage of regulation, of Regulation A+ is that liquidity message. If investors can get in and immediately have tradable shares, that changes the entire conversation around crowdfunding.
Definitely. Do you want to say something? No.
Well, I mean, I guess I can add to that by saying that, as far as the digital Hollywood space is concerned, the really exciting thing is that when we look at crowdfunding, it's brand new, at least in this way. It hasn't been around for even a year yet in equity, in this type of equity crowdfunding. And we've also, I think everybody in this room can recognize the power of the way that the digital media space has changed the way we deliver content to audiences. And I think we've all seen how quickly those audiences can grow and how surprisingly they can grow sometimes. So what I think is the best part about equity crowdfunding is how creative you can be, and the fact that there isn't really yet, we don't know what this is going to look like in 5 years. And so I would encourage anybody who's going to take this and go with it to be as creative as they can and tackle this in as many new ways as they can.
And so that's a great point. So Jeff, in terms of the road show with W.R. Hambrecht, what are some of the lessons learned that you can maybe share with us? Because these road shows are really, to what Jillian and Melinda were saying, really institutional investors, right?
Right.
But at the same time, you're trying to reach the consumer.
Yep.
And how are the two actually playing together at the moment?
Yeah, so I had a theory at the beginning of the process that if we had more of our audience signing up to potentially invest, that may drive institutional participation. There'd be some interplay between that. We haven't really seen that yet. From our perspective on the consumer marketing side, we're really running two things at once. There's a consumer marketing that we're doing that's easy for us because we do news every day. So in the middle of some of our news, you'll see bumpers for our IPO. So effectively, our audience gets to see that we're IPOing. The most effective creative that we have is around including our intention to list on NASDAQ. So it signals to the audience that, oh, okay, this is a serious business. It's going to have a serious sort of a brand behind it. We talk about Hambrecht sometimes. That matters a lot when we go to the institutional meetings. We have a banker behind us. So for us, it was a lot about trying to create the right triggers for people to understand we're a serious company, because they don't touch us. We're digital companies. They don't get to sort of see us. The investor video we did, which we produced, it cost us about $5,000, was basically a tour of our newsroom behind the scenes. And the reason that was effective is because it showed the audience we were a real business and we weren't just some sort of digital non-existent entity, and got a lot of good positive feedback for that. So we sort of tried to craft marketing creative for the crowd that both made them know we were serious, get them sort of behind the camera to sort of see our newsroom and how it works and the personalities we have. So we have anchors reading the news, which are very popular, so they sort of bring them through the process. And then the third best creative we run is sort of our mission. We try to do independent, objective news, the what, the where, the who, and the when. No analysis and opinion, no spin on what we do. And that resonates with our audience. It also resonates with investors. So we sort of are out there doing that marketing primarily through Facebook because that's where our audience is today. We do to our audience and lookalike audiences on Facebook. Lookalike audiences are incredibly effective as conversion tools for us, so people that look like our audience but aren't are today. And then we're running a traditional roadshow process, which involves broker-dealers, and as well as investment banks or traditional institutions. I think traditional institutions are not yet ready to do this at any kind of serious way. Half my meeting time is spent explaining Regulation A and talking about the business.
How much are you guys spending, do you plan on spending for your Reg A Plus offering?
So we...
Good question.
It's a good question. So we had originally budgeted a couple of $100,000. But we didn't really know. So we'd sort of had a couple $100,000 in the budget for the crowd. There's about maybe $50,000 in there for roadshow.
And that's running like Facebook ads and you know, display
Facebook and
ads
SEO,
and,
that kind of stuff. So that if people hit the Google search bar and they're looking for Newsbeat Social or Newsbeat IPO, they're bringing it, we're sort of capturing them in an SEO context. To date, though, we have dramatically underspent what we thought, and part of the reason is we're not qualified yet. So even though we've had tons of interest and people have put a lot of money on the board for us, I still don't know how that's going to convert.
So you're doing your own testing the waters.
Yes.
Right?
Yeah.
Maybe you can explain what that means.
So we're just out there with an IPO message to our crowd saying you can invest in our news company. Do you want to come sign up with us? They come and sign up. They indicate their country and their email. And then we push them to our banker's website where they fill out a little more information. So we kind of get the least amount of information we need from someone to have a lead, and then we move them down a funnel. So that once we're qualified with the SEC, we will then solicit them to come and invest. So today it looks great, and we spent really less than we had budgeted. I think it's because we have a big audience, so it's very cost effective for us to do this. But I still don't know what the math is going to be. I can tell you today, if the math holds up, we'll keep the round open post-qualification for like 3 or 4 weeks, and we may not even need institutions because the return is so good. But I can't say that with any sort of clarity at this stage.
Well,
So,
now, what's the timeline in your mind for getting this kind of?
yeah, so for us, you know, we engaged with Hambrecht & Company in July last year. We really started the process, I would say, in November with counsel. We filed on March 3rd. The SEC got back to us within their 28-day window. I think it was maybe 24 days. And we got a couple pages of comments from them. So we have to resubmit our financials because our financials got stale in that process. So we have another audit being completed. But we hope to be back to them with our comments from their letter by the end of next week. So by the end of this month, I think we'll be qualified. And then that's when the rubber will hit the road, which is all of this activity I have from my crowd. Now I'm going to see if they actually come to the bat and actually spend. And so for us, it's been about managing a process where we can activate our crowd, but also going out and talking to the traditional channels where you'd raise money from, like broker-dealers and investment banks.
And you know, you made a point that your hope was that the crowd would lead to institutional investment. And I actually have an ongoing wager with probably one of the best tech investors in the world up in Silicon Valley right now, that I actually think the crowd will outperform the institutionals over a 20-year horizon.
Yeah.
And I say that because the crowd's only going to back companies in which they use, you know, companies they love. And I don't know when product market fit was ever a bad thing.
Right.
You know, companies that have great product market fit with passionate, loyal communities, that sounds like a really good thing to me.
Right.
And I think we see a lot of businesses right now that don't have good product market fits and don't really know who they are, and they're raising ridiculous amounts of institutional capital. So I'm betting on the crowd to outperform the institutional
Well,
investors.
Yeah, no,
Pure
I agree with
mathematics.
Benson on
Yeah.
that completely
Yeah.
because it really should be, you know, as rewards-based as market validation and then people move up to equity. If you're playing at the equity game, the people that are using your product should believe in it. And not only that, I think it also teaches people about financial responsibility and what it is to be a shareholder. And so you're seeing millennials will have the opportunity for, you know, a couple $100 to be able to invest in the company. Ownership, as I say this because I'm working on iConsumer right now, ownership is the highest form of loyalty. So from a marketing perspective, iConsumer is essentially an Ebates, a Retail Me Not. But the more that you're shopping on the site, the more that you refer people, the more shares and ownership you have in the company. So ultimately, that company is going to be owned by its loyal users. You cannot ask for better democratization. I mean, it's essentially why Bernie Sanders was resonating at a pretty strong level, particularly with the millennials, because it's not about the 1%. It's really about the 99%, which is most of the population, and at least they can get into the game of investing. So it's not just the investment bankers, as I had dinner with an investment banker last night. We're making the 1% stay in the 1%.
Look at what just happened with Tesla. They sold 325,000 pre-sale vehicles. They sold 115,000 without anyone ever viewing the car. I mean, I have several buddies that couldn't afford a Tesla but own stock in Tesla, and they were like emotionally attached to Tesla, and they all put down their $1,000 because
Okay.
they'll get it back.
I didn't put down $1,000, but I did go buy Tesla stock that day. And my youngest son is named Nikola after Nikola Tesla.
There you go. But it's, I mean, it's a very powerful case study. It
Yeah.
kind of it's proving this idea that the crowd, when they fall in love with the company, they can support it. It works.
There have been a few of the meetings that we've done so far where the response from our crowd does drive some interest. I think what's also interesting about how we'll do our closing is once we're qualified by the SEC, most banks and institutions are used to funding on one day and you list the next. They're not used to you kind of spending a time closing around. They're like, what does this work? Like, you're going to take money into the crowd, into an escrow account, and then we're going to come in at the end. But that is, once they get, if they want to spend the time to understand it, and lots of them don't, they just say, well,
Yeah.
let's go to the next thing. But if they want to spend the time to understand it, they actually get a little bit more excited about, oh, the crowd will come in, so we can sort of see how you guys are doing in sort of reality. And the more of them that come in. So yeah, I think it'll be interesting to see how it works. I want to say that having more crowd investors will drive institutional investors to participate. I want to say it, I just can't tell you yet.
It's a lot of fun
I
to
mean,
disrupt
it-
these
it-
traditional methods.
It does right now on the reward side, right? So you now literally have the equity platforms searching which companies, like the Pebbles of the world, right? But you also have the venture community looking at Indiegogo and looking.
$850 million went into Indiegogo companies the last 2 years.
Yeah,
That's
and they
straight
have
out of
the,
their mouth.
They
yeah.
have the in-demand product now too, so they're really going to be Indiegogo's positioning themselves as the absolute leader in pre-sales. And pre-sales is literally about market validation, and then you can keep selling your product. And if you want true growth capital, you know, a great example is you know what Ken Hertz did with Giro. I worked on that a little bit. So the luggage company, we raised over $3 million, and we're going to do a Reg A Plus. And at the bottom line of what we said here is that the entrepreneurs get to raise money on their own terms. They do not have to bring in the VCs that then typically put people on the board, make you grow your company very fast, not always a good thing. You can look at Zynga and others that have gone through this. And then they oftentimes remove the CEO from their own company. So it's sort of like, it goes down to truly what are your business goals, what are objectives, what do you want to do? But the truth is crowdfunding now, both the rewards and the equity side, create unprecedented opportunity for entrepreneurs and issuers and for ideas that can change the world to come to life.
That are targeting consumers, which is what Digital Hollywood has been about for the last 2 decades, which, you know, I can't tell you, I've moderated a lot of venture capital panels. I did one yesterday. And, you know, the sadness in the room, every time, you know, we start discussing what they're investing in, and they're like, oh, we're investing in original technology that has IP and patents behind it. And that's like every time. And there's, you know, hundreds of people in the audience with slate of films or slate of creative projects that are not, you know, games, et cetera, that are not necessarily technology companies. Are you seeing that as being funded on your platforms, and why?
You mean, are we seeing technology companies being?
Digital media. More content-based than technology.
I think we're going to see. I think we're going to see a lot of that. I think as we were talking about before, it's all about the fans. It's all about the community. It's all about marketing. So I think there's certainly really interesting ways of doing that. If you have an incredible company that helps a business, makes sales to another business or something, you could get tons of capital from a traditional venture capitalist because it's a great business, but you're not going to be able to be successful with crowdfunding. So I think our panel versus a panel of venture capitalists, we're fundamentally looking at very different things to indicate success. So, I think there's certainly some overlap, but for at least with Start Engine, what we're looking at first is where's the community, or how can you build your community?
And that's very much, kind of shooting for the unicorn, opportunities, because when you look at the companies that are there, most of them have built these huge communities.
Yeah, and we're seeing, specifically with Film Finance, that I'm blanking on the name, but it was with Don Cheadle recently. The Miles Davis film. He raised, I think he raised like 20 million when it was all said and done, but he did a little bit over here and a little bit on Kickstarter and a little bit over here and a little bit over there, and a little bit from friends. And so I think we'll see Reg A+, Reg CF. You'll see some real films doing a piece of the equity on these platforms. Probably not the whole thing, at least out of the gate, but I think it will happen.
At least even for some companies that we've been working with, they're not even really doing this to get the capital, because it's not about getting capital. It's about involving their communities, involving their fans, and giving back in that way, like sharing the opportunity with people who support them.
Fascinating. So do you guys have any questions? We're kind of getting closer to the end of the panel, if you'd like to ask anything. All right, I have plenty more. Oh, go ahead.
Well, it's not, there's, so a lot of the platforms, they have like back-end technology that's basically facilitating the transfer of ownership into the company. So you're able to use some API technology and then embed that directly into your website. Does that make sense? So you can add basically an invest. Well, so you can do it on a crowdfunding platform. So specifically with all of the leading crowdfunding platforms, they're essentially a directory. So you can go to Flash Funders, Start Engine, Seed Invest, AngelList, and then as an investor, you can look at a bunch of different opportunities and search that way. Or there's another route where you can actually just add an Invest Now button directly to your company and then take an invest, but it has to go directly to what you would build is an investor landing page directly, which is what I'm doing right now, is building a direct investor landing page that looks exactly like a crowdfunder, a Start Engine page. And then we're just using Fund America, which I believe you guys use Fund America on the back end. So
yeah, I have 2 deals going through Fund America today.
Yeah,
so you could just look them up.
Yeah.
I have a question about Jack, right?
Jeff?
Jeff, sorry.
That's okay. People call me all sorts of things. That's okay.
Jack of all trades.
What you were doing in terms of testing the waters with your fans and your users, in terms of being potential investors, I always thought that you really couldn't, I guess this kind of goes to the legal aspect, that you couldn't really do that before. How does that work? How do you ask them in a way that doesn't violate sort of securities issues?
The whole point of Reg A Plus is to be able to advertise securities. But, okay, so how are we advertising securities without violating the law? Because we're going to the SEC and saying, give me permission to sell these securities, to sell them to whomever I would like, and to advertise to those people. So that's why this is a whole new world, a whole new business, and there are still rules you have to follow. With testing the waters specifically, gathering that information that Jeff is gathering beforehand, what he has to do is then take all of his advertising material and say to the SEC, here it is. He's not necessarily getting approval for that advertising material. It's just that he has to file that advertising
Because
material.
it's so expensive, the SEC identified that cost to actually file and to go through the process, so they allow you to do a testing the waters.
So you couldn't just send an email out to all your base and say, are any of you interested?
You
could.
absolutely
You
could.
can, but
You
there's
absolutely
going to
could.
be legal disclaimers you need to include that communication.
Yeah.
So you usually need a legal legend. So if you look at our content, you'll see if you check out Newsbeat socials on Facebook, you'll see these bumpers running in the middle, like a mid-roll running in the middle of the news report. It's like 5 seconds, and it will tell you about the IPO. You'll see a legal legend there. There's rules around how you communicate that legend through different kinds of digital platforms about how much you need to disclose, like how much writing you actually have to do. Because we're a video company, we can shoot video, so our stuff is sort of video-centric, so it's easy for us to create creative. We do a combination of introducing our audience to the IPO through our own news, with effectively what is an ad. We also do lead generation on Facebook. So those are direct solicitations on Facebook to audience and lookalike audience members, where we test a series of different creatives, whether it's images or videos or other kinds of things. We use Instagram as well. And we just track the cost of acquisition for us across all those platforms, which creative works the best, and then go with the champion creative and switch it up. Like, one of the things is we have to change creative probably every couple of days. Like, the cycle for creative to get exhausted in social media is quite fast. So again, we have an ability, because we make video, to do different cycles of creative, and every time you do new creative, there's another bump, and we kind of have to keep on top of that process as you go.
And
The
that
big-
doesn't require any legal.
Every single piece of creative is reviewed by our lawyers. So
It's a review, though.
It's
It's a review
reviewed.
and a submission.
Yeah.
It's not like the filing, which goes back and forth and gets approved.
right, so we give it to the SEC, and then if they have any problems with it, they'll let us know, but they
Yeah.
won't give us approval on it.
That-
But I mean, there's the
I
big
was just
question.
going to say, if they don't like it, they'll let you know.
So the most important question from what you're just asking, going down that direction, is really to Start Engine and to Flash Funders. Once you tested the waters, and let's say you subscribed $5 to $10 million, let's say, in investment, how many of those actually convert once the SEC approves the filing? And which is why I think GoChip decided not to test the waters, but perhaps it's a high percentage. So.
Yeah, well, first, I'll answer that. But one really cool thing about the Test the Waters campaign is that it was a very entrepreneurial thing for the SEC to put in there. And it can allow a company to test out some different marketing methods before they go forward with their raise. You can keep track of your data and say, okay, well, this is working or this isn't working. How do we rework our messaging? How do we reach out differently to get better results? And we have seen some companies that have done complete reworks of their campaign after a few results on the Test the Waters. There aren't that many case studies thus far, but what we're seeing is that about 50% of the investors who have indicated interest will end up coming through, and about 30% of the overall investment that was indicated ends up coming through. And that's because a lot of times the very highest amount, somebody who hits a button and says, I'm going to invest $50,000, they're actually less likely than somebody who says, I'm going to invest $15,000 or $3,000. So generally, that's what we're working with now. I do expect those predictive numbers to change and adjust. That's just what we've seen on our platform
In the early days.
in the very early days.
And how about you, Vincent? What do you
Yeah, I mean, I don't think there's enough case studies right now to
Not yet
even,
to comment
yeah,
on.
Yeah.
yeah.
I mean, I can comment from Crowdfunder because we saw, hundreds of deals go through, and the numbers, I'm just going to say they're far lower than what Start Engine is saying, because your sample size is so low. But it
were
was
those
different
Reg A
because
Plus?
we would take reservations.
For
in-
crowdfunding?
I have a saying that I tell every young entrepreneur, and I was told this when I was 21 raising capital. Raising capital is like the Grand Canyon. Committed versus funded. You can see it. It's not that far across the canyon, but there's a big hole you got to get across.
Yes.
And when it comes to taking pledges and actually getting people to part with their money is a big canyon to jump across. So I think those numbers are going way
Yeah,
down.
I mean, I had access to data that was like a couple, I'm not going to divulge exactly what it is, but it was a couple years worth of data because Crowdfunder was started in 2011. And you have to take a reservation which says you're showing interest, but you put in an amount, And then once you're using eShares, Fund America, Folio, Bank on the back end, you're actually now collecting the money. And it was a Grand Canyon leap between reservations and actual bankable dollars.
You can see
which
it.
ultimately
You
I
just
would
can't get
say
there.
reservations is a vanity metric.
Yeah. Well, I think though we should clarify, because with Crowdfunder you are doing Reg D, right?
Yeah, there's no question that there's a difference, right? I'm saying that there's a difference between
I would expect crowdfunder to be higher.
Yeah, I would
Sorry.
expect accredited investors to be higher than
Me
unaccredited,
too,
but
right?
I think pledges
Because-
versus
but if
committed.
you-
Great
yeah.
info.
And I'll say this, I put it in my book, and it's like on the pitfalls, and I have a whole chapter on like how to close investors, because I got to then determine which investors were better at closing, interview them, and then put those secrets in my book. Because there is an art form to closing investors.
I mean, I've raised millions of dollars for businesses going back to when I was 21 years old, and over 90% of people that committed and told me they were going to invest never did. I mean, that's just every entrepreneur in this room who's ever tried to raise capital has been through it, and it's almost better to get a quick no, than a slow
The, like 8 rounds of due diligence with client
Yeah.
where they figure out
Oh
what
yeah,
they're doing.
yeah. I mean, I'm going through that process, every day still. Yeah.
Yeah, but I do think that I think that we will see a difference when we're talking about a Reg D, where you're only going to accredited investors who are doing this not because they're necessarily passionate about a project or a company or a CEO, but because they're trying to make smart investments. And I think those people are more likely to go through and indicate interest in larger amounts, because that's how much they're looking to invest, and then take that funnel and only put all their money into one of those companies. Whereas with non-accredited investors, I think we do see a different reason for the investment. And again, we do have very few case studies, but we have seen that across more than one of our companies, that we are seeing a significantly higher conversion rate than what
That's cool.
you guys are
Well, and
looking at.
Title III will, obviously, May 16th, we'll get more data.
Right.
Because that's opening up to non-accredited
Yeah.
investors, right?
At a very
Yep.
interesting levels.
Yes.
Yeah.
Where almost anyone can invest.
Yeah, I mean, right now
Making it
it's the
very
wild,
accessible.
wild west. So if you're an entrepreneur and an issuer and you know how to market and you're smart and you've got something that's viable, take the money now,
I'm curious of the panel, how many of you are super excited about Reg CF?
I am.
Okay, all right, that says it all.
Kinsey's the future of this panel.
I'm very excited about all of
I love
this.
it.
I think that's
Well,
pretty clear.
I also think that it's an iterative process, right? So if Congress and the Senate feels like, Reg CF has some regulations that aren't really working and it's not actually creating jobs and getting investment, people will step forward and make changes. So I think that it's an evolution.
The problem with Reg CF right now is it's too expensive.
Yeah.
And too time consuming to actually launch a Reg CF offering. And I don't think they should deregulate it further. I think
the amount of money raised.
Yeah,
Yeah,
and
a
that's the
million.
problem for the amount of money you can raise. And so to lower the friction, a platform could step in and get more hands-on and do a lot of the work for companies. But if a platform is going to take on more ownership, then they want to raise larger dollar amounts. So they're going to stay away from Reg CF.
Right.
And from a regulation standpoint, when I take off my flash funders cap, because my flash funders cap, I want deregulation, I want to raise capital for everyone, I want it to be easy. But when I put my like good citizen cap on, this industry shouldn't be any more deregulated. I mean, we don't want a bubble. In 2000, people were able to invest unlimited amounts of capital into complete crap, and that could happen very quickly if they don't have investor limits, if they don't make companies get scrubbed a little bit with financial reviews, if they don't make them file Form Cs. We could have companies raising crap from people that should not be investing capital in them. So
But
there has to be a
it's
balance.
interesting because I was part of the bubble, so I
Yeah.
had an incubator in the bubble and before and after. And interestingly enough, when the companies raised quite a bit of money and some of them went public without business models, when the bubble burst, the companies that had a business model and had revenues and had consumers could not raise the money. So what we ended up doing is merging the public companies that had the cash still some cash left with the companies that had a business model and trying to
Yeah.
grow. So it was kind of like an early
Yeah.
Reg A plus.
It
was
was.
just
Yeah.
without all the regulation behind it. So I think what you're saying is that the cycle will happen, the bubble will probably happen here, and in the other area I was discussing the RAR. But then you have to sort of be prudent investor, which is what you guys
Well, yeah,
are.
that's the, when I was getting, I'm sort of a recovering banker from a while ago in my career, but when I was getting familiar with this process, it was surprising to me that companies can go and raise money from their crowd really at any valuation they choose. And that poses some unique problems.
Which you don't want to
Which
do,
you don't
though.
want to do.
Because then you're never raising capital
well, especially,
again.
Well, especially if you plan on listing your company, the second you go out to public markets and institutions and others look at your company, they're going to sell your stock. They're going to move you down that chain pretty fast. And all your customers who had all this faith in you are going to take a bath. And so what was surprising is there really are no rules around valuation. So it's up to the entrepreneurs to be smart about that, because you just don't want to take your top 2% of your customers or your fans that are going to back your project and have them take a bath on their investment because you've been either greedy or sort of ignorant about what the valuation of your company should be. So that's part of the reason we're working with
You are
banks.
growing a business, is what you're saying, bubble or not, right? You're trying to grow.
Yeah, well, I mean, it's part of the reason
Yeah.
that we're going and talking to banks. Again, like, I don't know whether they're going to come in or not on these kinds of offerings at this stage, but it certainly is instructive around things like valuation and aftermarket support, because if they're not investing today, they may invest in 12 months. At least they know the management team. So.
Makes so much sense. So in terms of any more questions, and then I'll have them give you sort of some words of wisdom as parting comments. Okay, we're exhausted the questions. This is the last panel at Digital Hollywood. I think we're finishing by far last here. Not in the presentational sense, but in just timing. So, Jeff, you want to kind of tell us what are some of the most important things, or one most important thing that you'd like to leave the audience with today?
Just as we're going through this, really is one of the earlier companies to be doing it, because there just hasn't been a ton of experience here yet. It is a bit of the Wild West, and you have to be prepared to just roll with the punches and sort of figure out what works. It's a very entrepreneurial way to raise capital, and you need to respond to data, you need to test things, you need to try new things, and if you're going to be early doing this stuff, you might as well take advantage of the fact that there really hasn't been a lot of rules and extra structure put around this yet, so you can be entrepreneurial, but it's not without its risks. There are lots of other stuff you need to do to be successful in this kind of raise versus going a traditional path. And you should really understand what your business objectives are and what you're trying to do with your business before you decide to go down this path, to whether or not it makes sense for you, because I do not think it makes sense for everyone or for every kind of company, but it can be great, particularly for media companies that have audience and have fans. That's the kind of thing where that gets me excited about Regulation A. But think hard about doing it. It's not like it should be, it's just easier than going to institutions or VCs. You shouldn't really think of it that way. You're like, what am I trying to do by raising money from my crowd? Because if your business can't sort of withstand the strength of going to a traditional investor, you should be asking questions about why that's the case first, before you then go try to just raise money from the crowd because you think it may be easier. It's not like a sort of panacea catch-all to just get money because people might be interested in you. So just be thoughtful about it. But it can be great if you're doing it for the right reasons.
Makes sense.
Yeah, I agree with everything Jeff just said. If you don't need to raise capital for your business, don't raise capital. Try to start a business where you don't need to raise capital. Like, that's the best piece of advice I could give everyone is get your business profitable and grow internally if possible. But if you do need to raise capital, start with your objective. So create a sheet, spreadsheet, whatever you want to do. Write down the pros and cons, and look at capital raising not as crowdfunding. I'm going to go raise dumb money from dumb investors, or I'm going to raise some institutionals. Look at it from the perspective of, I have a business. Here's my business objectives. I need to raise this amount of money. Historically, you had one pathway, and it was through a Regulation D private placement. And you could raise capital from VCs and from private equity and maybe from high net worths. And so today, you now have a couple additional pathways to go. And they all have pros and cons. And so my advice, and same thing that Jeff just said, is identify what you're trying to do with your business. What do you need to get to the next level? How much capital do you need to raise? And then look at the pros and cons of each pathway. So if I go down the traditional Reg D private placement route, Here's the pros and cons. And if I go down this pathway, Reg A plus, here's the pros and cons. And if I go down this pathway, here's the pros and cons. And make the decision that's best for the business. And it may be Reg A plus. I mean, I think it's going to be Reg A plus for a lot of companies, but it might not. And don't do it because you think it's easier, because it's not easier. There's no such thing as getting rich quick, or don't chase shiny objects. It is just as difficult as raising capital the traditional route. It's just a different way to do it. That's really the feedback that I try to give to entrepreneurs. It's not easier. I'm sure, Jeff, it's no easier.
Yeah, Jeff, to his point, said he's a digital media company, and that was just challenging to get the right VCs assembled at the right time.
Yeah.
But he is talking to them, and he's talking to both, and you're talking to both private and public markets at the same time. Kinsey, what are some words of wisdom?
Well, I guess I'll just add a little bit to that. If you guys do decide to go with a Reg A plus, do your research. Make sure that it's right for your company or your project. Think about what you're doing and whether or not there's going to be a big return on it, and who those investors would be. If you're reaching out to the crowd, what do those investors look like? How do you find them? How do you communicate with them? And also, how do you protect them? How do you make sure that they're going to get a return on their investment? So definitely think about that. And if you're finding that you have a great pathway there, be creative, because we have not seen the most innovative ways of doing this yet. And I'm really, I'm excited. I'm really excited to see what the next big raise looks like.
Okay, that's wonderful. Jillian?
My advice is this. You got to figure out what, investors ask 3 questions. What are you investing my money in? How much of my money do you need? And when am I going to get my money back? And that's what they want to know. So figure that out first, and then you can call me.
Oh, Jillian.
So I will say that we're absolutely in an age of excellence, and don't underestimate the power of marketing and the power of storytelling, and making sure that after they've all said other points, so now you agree with their points, so I'm just going to add another one, is before you press the launch button, on a campaign, make sure that you've tested it with people that you really know and trust, and that everything is exactly where it should be, or otherwise don't do it. Just don't press the go button, and hire. You'll have to raise a little bit of money from friends and family, and make sure that you have enough money to hire the right people to help you tell your story.
And you really need a team of people. I mean, Jeff has a company, so he has his team inside the company. You do need someone to market this, right? Absolutely. You need legal advice. You need bankers and or people who can help you raise money. You may, even if you sign up W.R. Hambrecht, you still need help preparing everything.
Yeah, and so when I'm going to plug my book on that, sorry, I'm being shameless.
Give you
but both, yeah, because I have a resource guide that has 20 pages in there, and in fact, Vincent, you're on the cover of my book.
All right.
So is Ron Miller from Start Engine on the cover of my book. So it's I did create that resource guide so that you really you hear direct.
What's the book name?
So it's called How to Raise Money: The Ultimate Guide to Crowdfunding, and it's on Amazon. It's less than $10, and I'm telling you that resource book is worth it. And you get to hear from the gentleman on this panel, and me,
and then
and
Jillian
others.
has a book too.
Yeah.
It's
And Melinda's in my book.
Yes, there you go. We're gonna and I just
Melinda's
promoted
on the
her book.
cover. No, I'm just kidding. Okay, what does it say? The crowdfunding myth, right?
Yes.
And so what does the book do for you?
This is more of a legal guide to tell you exactly how you can raise money legally, and then I have a whole section on there on marketing and some words of wisdom from a variety of crowdfunding portals to tell you how to prepare properly to get listed on their crowdfunding portal.
And I want to thank you for being here at the very last day of the conference, after the conference was over. So thank you for staying. And I want to thank the panel for sharing all that information.
Thank you.
Great job.
Awesome. Thank you.